Okay, let's start. Slightly 8 o'clock, so thank you very much for coming and to attend this session at such a terrible time. The nice thing about this session is that it is the only one, so there is no parallel session. But the time was not really optimal. But we're happy to have first almost 5 speakers, and to have almost more people in the public in the audience than the number of speakers. So let's start without any other direction. So the first speaker will be Nicolas Lippolis, who will be presenting a paper on the title of which is Bargaining for Sovereignty, Explaining African Participation in the G20 Common Framework for Debt Treatment. As you can see, this is a very timely topic.
Okay, so there's a few people coming downstairs, coming to the topic, but should we start? Sweet.
I think we would rather not lose too much time.
Okay, let's go.
The only thing that I forgot to indicate the rules of the game, which will be you will have 15 minutes for everybody. If we want to have 5 minutes Q&A at the end.
Okay.
If you go beyond 15 minutes, then there might be no Q&A.
Okay.
Benigni says that there is no Q&A session needs.
Okay.
Please, there understand.
Okay, but if you may have Q&A. Okay, that's it.
Okay, let's go fast. I'll try to go fast and please. So this is very much work in progress, but hopefully there will be some interesting insights for everyone. And I think the title speaks for itself. To start with the context, we had a period from the early 2000s where debt forgiveness changed the context for the conjuncture for African countries. Diminishing debt levels gave them much more greater room to get loans, to invest in transformational projects. Alexa, who's here in the audience, has spoken about the idea of paying for sovereignty, right? The idea that less debt-constrained countries had greater freedom to invest in their own development strategies, had much greater policy autonomy, and which enhanced their sovereignty. But over time, debt levels started increasing again. So you see here the curve. I think it's pretty clear from the year 2000, the reduction, then a gradual increase over time. And so a lot has been written during the 2000s, 2010s, and how this the freedom given by the greater sovereignty of African countries and the diversification actually of the external environment was enabling for African governments because they can get loans not only say from the Western official institutions, but also from China, from Eurobond markets, etc. And so I think it's been pretty established that this has been enhancing for them. But now once debt levels started rising and this external environment become less benign, there's a question as to whether they have the same freedom of maneuver and whether the diversification of the global economy becomes as enabling or actually can be more constrained for African governments, right? And so the paper is about the G20 Common Framework for Debt Treatments. And in this context of gradually rising debt levels, you have the COVID shock, which aggravated all these pre-existing trends. And then, I think most people here are familiar with the DSSI, the Common Framework. That's common. The conference is about that. But as we have written elsewhere with my colleague Verhoeven, the DSSI Common Framework introduces ways of fixing or dealing with mostly African countries, but low-income countries aggravating that problem, were largely also a tool of geopolitical competition in the US and China, right? And we've seen how, and there's plenty of panels, I'm sure, in this conference we've discussed this, that Chinese resistance, US-China competition, and Chinese resistance to some of the provisions that are seen as working against them has stalled a lot of the restructurings, right? And in this context of the politicization of initiatives for debt, there's a puzzle. Firstly, as to why countries adhere to the common framework, since we know about its limitations, especially non-defaulting countries. For countries that are in default, it's pretty clear, the common framework is a game in town, so there's not much to think about it. But for non-defaulting countries, that's preemptive with restructuring, it's not obvious why they adhere to an initiative that has so many shortcomings, right? And so this is an inroad, again, it's starting up with the question of the diversification of the global political economy and how enabling or not it is. Looking at the adherence to the common framework is also a way of understanding, in this case, African countries, where you can think about poor countries in general, but in this case, specifically African countries, which are the most of the beneficiaries of the SSI and most of the highly indebted countries, how they navigate this changing external environment, this changing geopolitical and financial environment. And this is the question that we discuss in this paper. So this is I won't go in detail into this, but there's some literature on why countries would preemptively restructure their debt. Here, expected costs and benefits, makeup of creditor group, contractual environment, political characteristics, etc. But the issue is here, there's perhaps an asymmetry in the literature, right? Because usually decisions to restructure are modeled exclusively as being about financing and financing choices by governments. While it's well established that the common framework is about more than just financing or debt, it's also about politics. But there's missing in existing literature an account of how countries that support the beneficiaries of the common framework, how they see it politically, right? So if there's a geopolitics in terms of the creditors, there must be a geopolitics of the debtors. But that is an area that has been underdeveloped in the research, and that's where the paper seeks to contribute. And so we draw on the literature on African states and their position in the global political economy and how they use their weakness to give them greater room for maneuver internationally, but also to strengthen domestic political rule, right? This idea of extroversion and the politics of the weak states. And also we look at the connection between financing choices and external political alignment. Good morning. There's a well-developed Africanist literature on this, and we seek to reach with some of the insights for international political economy. And so the argument that we make, again, this is all still work in progress, but I think this is a good working argument for us, is that the decision to adhere to the common framework is, well, states that had accumulated a lot of non-traditional debt. By non-traditional, I mean China, but also commodity traders, more opaque private financial institutions, and others that perhaps don't adhere to the highest standards of transparency. Then states that, so that's kind of these are like necessary conditions, but not sufficient. This is one condition. The other condition is that states have sought to rebalance their relations toward the geopolitical West, because the common framework is very much a way of bringing China into the well-oiled system for sovereign debt restructuring. And so adhering to the common framework is a way of realigning from these non-traditional sources of debt towards the traditional ones. But then the countries will only go for the common framework and decide to preemptively restructure their debt if they don't have access to alternative sources of finance, right? Because then it's not convenient to go for restructuring because you lose access, especially to your bond market, right? Again, these are necessary but not sufficient conditions. And the reason for this is that in a context of uncertainty about the effects of a common framework, how it works, and fast change in global politics, it's very hard to assess the costs and benefits of adhering to these initiatives. So quickly, I won't be able to do justice to the case studies because it's 4 case studies and we have limited time. This is one of the criteria for case selection, but I think it's an important one. Is there something here on the screen?
Yes, it's not here.
Okay. The criteria for case selection. So with having China as a major creditor, of course, is an important one. We have Angola and Ethiopia, which are the top 2 largest recipients of Chinese finance in Africa. And being an oil exporter, we expect this to matter because it changes your engagement with the global financial system, right? Because even though your finances are not well management, you always have access to additional finance, to oil-backed loans, and guarantees and so forth. And so we see that in these cases, we have, in the countries that are not a major creditor, that's Chad, that adheres to the common framework, one that China is a major creditor, Ethiopia that adhered, and similar for oil exporters. So we have some interesting variation there. So starting with Ethiopia, just telling very briefly the story, how non-traditional debt was accumulated. You have this idea of the Ethiopian developmental states, strong, great relations with China, allowed them to borrow a lot for transformative projects. They had a very ambitious development strategy. But then the investments, the borrowing from China and others to invest in infrastructure and industrial projects did not yield the expected returns. So at some point, increased political contestation came in. the EPRDF regime started losing popular support for reasons that might or might not be economically related. Around 2015, you had major protests and a crisis that eventually resulted in 2018, Abiy Ahmed coming to power. I won't get into the details of that. And he introduced a homegrown economic reform agenda, which is basically a liberalizing agenda, which the homegrown, adhered very much to IMF precepts, but they want to make sure that the optics were right. So they call it the homegrown economic reform agenda. And this was accompanied by a pro-US political realignment, because the EPRDF regime that preceded Abiy Ahmed was seen as very pro-China. And so, and we argue in more detail in the paper, the adherence to the common framework was a way to blame the EPRDF for pre-existing problems in the European economy, boost the liberalization agenda, because we're gaining also US support from that, again, US support, and also US support for fighting against the domestic insurgency in Tigray and Oromia. And also something perhaps that we should mention is that Ethiopia, by virtue of being indebted, not even having very low exports, just the structural economic condition, didn't really have the prospect, once they became highly indebted, didn't really have the prospect of accessing other sources of financing, right? And you can see here the debt profile, proportional to China's 27.3%, which is an important chunk. But you see debt service is very high as proportion of exports. And you can see that the difference between the debt stock and the debt service is telling us to the limited repayment capacity and how the debt was very expensive for Ethiopia's economy. And so this decision to realign with the US, 5 minutes, did not yield the expected results, because basically Abiy Ahmed started a war in Tigray, the Biden administration came in, human rights violations, sanctions, and so forth, and so the restructuring didn't go forward. So this is a case of it, they had expected benefits from adhering to the common framework, but they weren't necessarily there. Secondly, Angola has a well-oiled system, a country that's been chronically highly indebted, but because it has oil and over in the 80s and 90s, oil had rising oil production, that allowed it to develop a modus operandi in terms of oil-backed loans and preference for bilateral restructuring rather than multilateralizing its debt. From 2004 onwards, China became a major creditor and helped Angola in its post-war reconstruction. But then the oil price fell. The country became more vulnerable to China because it accumulated so much China debt. You see 46.6%, around $21 billion, by far the highest in sub-Saharan Africa, one of the highest in the world. There were some movements towards realigning relations, but finally in 2017, with João Lourenço coming to power, this happened. But I think the punchline here is that the realignment in Angola happened prior to COVID. They had oil. They managed to use their bargaining position very well. They had the prospect of accessing Eurobond finance, so they didn't need to consider the common frame, right? But let me move fast, and then they're happy to Q&A if you get any more detail. Chad, low proportional to China, but 43% of private creditors, which is Glencore, right? So there's a very important Glencore loan given 2014 to Chad, which had discovered oil about 10 years before. But this is in the context of constant security threat to the regime. So the oil ranks were diverted to securing military support and fighting insurgents. Then, security conditions went bad. The loan was very unfavorable to Chad, highly indebted, bad security conditions, bad economic conditions. At some point, Chad decides to turn to France for support and negotiate against Glencore and getting the means to fight domestic insurgencies. And that is the story for why they adhere to the common framework. I'm accelerating here. Finally, Cape Verde, which is a counterfactual. Democracy from the 1990s, it became completely aligned with the West, very dependent on the West, bet on tourism. In 2008, it lost low income status, least developed country status, and started accessing, but still managed to maintain access to concessional loans, so never really turned to China, private markets, any of that. They had a well-oiled strategy of keeping to concessional finance, which in theory allowed them to escape the real massive shock that COVID was, because tourism-dependent economy, COVID was a huge shock to them. But they managed to survive, arguably because of this concessional profile of loans. Although there's something to be said about using the DSSI and using COVID as an excuse to reprofile a lot of the payments that are going to mature. And so in many ways, it's a model student. So it's a counterfactual to what happens in countries that do not accumulate all this alternative debt, but it's also very dependent on Western-led institutions. The last part of the model student, I can get into, I can discuss later if anyone's interested. So just to conclude, so what has been the effect of diversifying global landscape on these debtors? Well, for Angola, it has been pretty much enabling because the country has had, awful financial management, but it's still able, the regime is still in place, it's still able to extract concessions from inside. In Chad and Ethiopia, it's been double-edged. It was enabling, the diversification was enabling when the countries were doing well, but when they entered into crisis, they really struggled to resolve their debt situation. For Cape Verde, it didn't change very much because they never got many Chinese loans, never accessed private credit markets. And so we can say the conclusion to this that there's diversification in the credit landscape has diversified effects on states' autonomy to pursue, on states' policy autonomy. So this is a way of contributing, the contribution of the paper is bringing to light how debtors and not just creditors exercise their agency, and also how African governments strategize around their external engagement to pursue their own goals. And then there's also some further insights on miscalculation in the Ethiopian case. That's something we argue. My co-author, Harry Verhoeven, has written about this often in the foreign policy context. Also on how Angola, perhaps having more experience in Chad in managing oil, was able to cut better deals and they survived more unscathed from the whole COVID shock. And also the Cape Verde is a counterfactual to what other African countries did in seeking their own autonomy. What happens when a country does not seek their autonomy? And again, we can discuss the Cape Verde case a little bit more in depth if anyone has interest. So I think my time is over. Thank you very much.
Okay, thank you very much for this presentation and for being right on time. So we have some minutes for some questions or comments. Who would like to be coming? Yes, please go ahead.
So you think the politics play via direct bilateral contacts, so China is asking so and so it's not to go to the common framework for us, or France is asking directly to go to the common framework, or is it more subtle?
It's more subtle, I think, and obviously, so the first, whoever exerts pressure different, right? So in the Angolan case, a lot of it was via the IMF. I think in a country like Chad, there's a lot of more like direct French connection, right? I think there's kind of hints, and as we mentioned in the paper, and sometimes it's just a hint that relations will benefit from adhering to the common framework. But in other cases, I've actually been interviewed some people in Angola, and they're like, there's a lot of pressure on the IMF. These guys were, bargaining very hard. And so there's, it's usually there's the bilateral aspect, France, mostly France or the USA, but there's also the IMF, which also has the same. I don't know if you're that very trying to.
There's a question there.
Thanks for your presentation. So I'm wondering how much you see this agency also exercised at an earlier stage, because of course part of what shapes whether countries participated is this cutoff around eligibility, and some middle-income countries simply don't have access to they don't have access to a common president. And so, what is your sense about how bargaining? What agency they had to bargain in that earlier stage in the designing of the BSSI and extension of the common framework, such that some countries were excluded. And I was also wondering, if you frame this around the puzzle of why do countries participate in the common framework, but the main challenge the common framework has had is why do countries not participate in this common framework? And so I'm wondering whether you think your explanation can apply to several other countries that have chosen not to. Is it because they fear antagonizing China that they're
not? Very good question. On the design of the SSI and common framework, I haven't really looked into this. I know maybe you have some information on this. I wasn't aware that they took a big role in the. My impression is, for example, Angola technically would not have been eligible because of its income status, but perhaps because of its significance as the largest recipient of Chinese loans in Africa, it was important to include it. And the SSI played a role in helping Angola restructure, or not. So the DSSI was also instrumentalized by these countries to reprofile their loans, even vis-a-vis China, even Chinese institutions do not participate in the DSSI officially, right? But I don't know if they participated in the design of these programs. That would be useful, but maybe it's true. And the second question on agency, on the middle. So what's the second one? Non-participation. So that's an interesting question, right? Because I think to explain non-participation, we could take participation. So there isn't much variation in this area. Because and again, just Chad and Ethiopia, the only non-defaulting country that do, because Zambia and Ghana, it's a less of a puzzling choice, right? And the idea is to look at the positive cases to shed light on the negative cases, right? And so, in terms of non-participation, I think what it shows is that the Chad and Ethiopian case were very, very specific cases of the geopolitical circumstances that favored the alignment. And I think it will be rare to find countries with so much large non-traditional debt, and which at this given point in time, because of domestic challenges, were so strongly compelled to realign themselves to the West. I feel often the debt situation might not be there, might not be similar, comparable, or the political incentives might not be there. So in a way, it's a very fortuitous set of circumstances that might be not rare to find in other countries. Perhaps this could be the explanation, thinking about the external validity of the argument. But thanks for pointing out. That's something perhaps that I should highlight.
Okay, very short question and a very short answer.
More kind of question is a comment, because I look at the case of Tab. I struggle to see the double-edged features of the guy's classification there. I think Glencore is one of the most extractive creditors that you can find in the planet.
Yeah. So it's a non-traditional sort of that, right? So in a way, the idea was to use a common framework as leverage to bargain with Glencore and extract concession for them. It failed because when the oil price rose, they argued that the cash had to pay.
Chad's money from oil doesn't even have tax anti.
Yeah.
The money goes to escrow account and it goes directly.
Yeah.
It's mad.
But they tried to bargain with them. But then they didn't manage, right? And but when they originated this loan, there's some revelations came out. There was a middleman for Chad, between Chad and Glencore, and they found out later that he was working for Glencore. And so the Glencore, they cheated on Chad. They swindled the Italians. But yeah, that is.
Okay, so we have to stop here. Thank you very much. Now the second presentation by Giovanni Bonfanti. And the paper, this title is Convenience Euros, Investment Mandates and Conditional QP.
Right, thank you all for coming to my talk today. Today I'm going to talk about interest rates in Europe and how they are determined. In particular, I'm going to make the claim that convenience yields, meaning that interest rates that are lower than what you expect given the market conditions, are driven by the size of potential investors. This is a very new concept that I will try to convince you of today. Just as a starting fact, interest rates vary across currencies, across issuers even within the same currencies, and over time. And there's a large body of evidence to this. More specifically, the question that I will answer today is, why is it government bonds that are so special and not other issuers? Now, this is a trivial question, for example, in the US or in the UK, where there is a single very large treasury issuers, and of course, it's special for a bunch of reasons. But that is not the case in the EU and specifically in euros for two reasons. First of all, here we have a bunch of large, very liquid AAA rated issuers. And here you can think of France, Germany, the Netherlands, and so on and so forth, but also many supranationals. And among these, you should think of the European Union, the European Investment Bank, and also policy banks like KfW in Germany or CDC in France. And the second fact is that the ECB, the European Central Bank, has to treat all these sovereign issuers equally, including the supranationals. Okay, so the ECB by law cannot discriminate between these, at least exemptly. However, what I'm going to show you in the next slides is that all these institutions pay very different interest rates, both in the cross section and over time. And as sort of the explanation that I will try to convince you of today is that what really matters to determine interest rates ex ante is liquidity during crisis. And what influences liquidity during crisis? Now, in the cross section, so comparing different issuers, what matters is investment mandates, which can exclude some issuers from the investment universe of an investor. So let me give you an example. Imagine you're the European Investment Bank, you're a AAA rated, very large, very liquid, very established issuer. Not all investors can hold your bonds. That is just because you are not formally a government. So what you issue is not a government bond. You issue a corporate bond or something in between. And so some investors cannot access this. And you might think that shouldn't matter. Well, I would argue that this matters because in a crisis, if an investor wants to liquidate a position in bonds held by issued by a particular issuer, this investor would want to quickly find a buyer. And so it's key to have sort of a large base of potential investors. So this is for the cross-section. For the time series instead, I'm going to argue that what really matters is expectations about conditional QE. And by conditional QE, here I mean the willingness of the ECB to intervene during crisis and purchase everything on the market. Now, this really matters if the size of, if you only have fewer potential investors like supranationals have, because then it really matters that there is someone like the ECB there to buy your bonds in a crisis. All right. So I have 3 facts for you today. They're quite simple, but I'd like to spend most of my time on those. And please feel free to interrupt me even during it if there's something that's particularly not clear. So I'm plotting here for you the 10-year yield to maturity in percentage points for a number of issuers. So this is how much the different institutions and countries pay to borrow on the market. Here we have 4 institutions related to the European Union. Then we have KfW, again, the policy bank, guaranteed by law by the German government, Spain and Germany. Every single issuer on this plot is AAA rated. It's considered super safe, super liquid, and the size of this market is comparable. What you can see is that over the past 6 years, first of all European institutions paid the exact same interest rate, which is surprising if you are even vaguely familiar with what these institutions do. These are completely different institutions. They do completely different things. They have very different legal structure. They have different set of borrowers, different set of creditors, and yet they pay the exact same interest rate, meaning that the market seems to treat all these as exactly the same. And on top of this, you cannot even distinguish the black lines from the yellow line, meaning that like even Germany guaranteed KfW pays the exact same interest rate as all the others. And yet these institutions have very different risk profiles, liquidity, and a bunch of other issues. And you can also see that, especially towards the latter part of the sample, these supranationals pay a significant premium relative to Germany and almost pay the same interest rate as Spain, country that was on the brink of default just 13 years ago. Okay. Now, what do these supranationals have in common? Only one thing: the legal status. Okay, so they are neither governments nor corporates. They are something in between. Okay, so I'm going to argue that this legal status is what determines the size of potential investors in their bonds, which in turn determines how much they pay. Okay, so this is just to say that, like, again, the bottom line is that all supranationals pay the exact same interest rate, and we need to find out why. Second fact is that it's the premium that these supranationals must pay relative to Germany or any other country is very large, and it varies with maturity. So I'm plotting here for you the yield curve, meaning how much these institutions need to pay to borrow at specific maturities. And here I have the same issuers as before, but even added the Netherlands and France, just to have a comparison. Of course, Germany is at the bottom, so Germany is the issuer that pays the least, and then we have the Netherlands and France. And then you can see that once again, all the supranationals pay the exact same interest rate at every single maturity, which is very surprising. And they must pay a very large premium relative to their countries, even to a country like the Netherlands, which is much smaller, or France, which is not AAA rated, it's AA rated. Okay, and this premium is particularly large at short maturities. If you look at this, for maturities up to 4 years, these supranationals must pay more than Spain. Okay, this is very significant. And this will also explain why there's been such a low take-off of these EU loans to countries, because it's very expensive to countries to incur into these loans. Okay, and the last thing, I just want to say that, like, for very long maturities, you do see a discrepancy between what KfW pays and what the other supranationals pay. And so I would claim that there is demand segmentation. And it might be true that investors prefer German safety than European safety. However, this really doesn't seem to matter on the vast majority of the tenors. And I want to say that like 80% of the borrowing occurs at shorter maturities. All right. The last fact that I want to discuss here with you is the supranationals are most affected by the ECB. Okay. So so far I've only discussed cross-sectional evidence, and now I want to discuss time series evidence. So I'm plotting here for you the 10-year yield spread to German government bonds, meaning I take whatever issuer, whatever interest rate the issuer pays, and I subtract what Germany pays at the same date. Okay, so these abstracts from the absolute level of interest rate, and you can see that like up to early 2022, institutions paid sort of a fixed spread to Germany. So interest rate moved up and down all throughout, but like spreads were sort of constant. And Spain was paying the largest spread, and then the Netherlands was paying the lowest spread. And supranationals were sort of in between. However, on the 3rd of February 2022, Christine Lagarde held a press conference in which she did not say anything about interest rate, nothing about QE, which she had already announced would end, but it's sort of an hawkish tone. And so the Financial Times termed their conference a hawkish shift. This triggered a massive rise in spreads for all issuers relative to Germany. Okay, so you can see the spreads sort of double for all issuers, but they increased particularly for supranationals. And in particular, the spread in supranationals must now pay is even higher than France. Okay, so this was not the case before. And if you look back in time, the supranationals had never paid more than France, never in their entire history. Okay, so something key happened here. What I would argue is that what the market inferred of the ECB on the 3rd of February 2022 is that the ECB was really serious about fighting inflation. It was really serious about shrinking its balance sheet, which is not just discontinuing QE, because that was already announced, we know, effect on spreads. But what really changed is conditional QE. So the market understood that if liquidity crises were to come along, ECB would not be there to buy stuff. And this affects particularly supranationals, which have a smaller pool of potential investors due to restrictions imposed by investment mandates. All right. Then I have a quick model of market segmentation and liquidity needs. I won't go into the details of the model. I just want to say that I sort of think of investors as grouped into two categories: pension funds and insurance companies, and mutual funds. Pension funds and insurance companies have long-dated liabilities, so they're happy to buy and hold to maturity, so they don't care about fluctuations in prices. But mutual funds do really care about their ability to sell stuff in a market run. And this is sort of what determines prices and interest rate. And not only that, but it also determines the investor base. So given this, you might expect that insurance companies and pension funds will pile on to supranationals, which are very convenient because they offer a very high spread, but they're also very safe, while mutual funds will focus instead on the government bonds, which are more expensive, but hold more of the price during the crisis. Here I'm discussing sort of what I mentioned about conditional QE. So the idea that when ECB is around and is expected to buy everything, then you don't really care about whether you're supranational or not. Because in a crisis, you know that ECB will always be there to buy everything that you throw at them. And this is exactly what they did for the past 15 years. And the game had been going on until February 2022, when the market realized that the ECB would not be around forever. And now these differences in the size of potential investors would really matter. Okay. I just have actually, let me skip this and focus more on the conclusions. So here I argue that there is an important but neglected role for the size of potential investors, and this is very large. So on a 10-year interest rate, this can be responsible for up to 100 basis points. So this is a massive size, and the European Union as a whole spends something in the order of 30 billion euros per year, more than what we should be paying. This imposes large cost on mutual funds because, again, they're the ones that must buy these expensive German bonds rather than the cheap supranationals. But it's a source of rents for pension funds and insurance companies. So there's sort of like some redistribution across investors of the economy. And there are three broad policy implications. First of all, is that issuing non-governments is costly, and this might be most relevant to this audience. So when a country, especially a developed country in Europe, has to choose how to finance itself, it must take into account the fact that issuing through a supranational or to a multilateral institution is much more expensive than issuing its own bonds, even if the bonds are lower rated. And then again, that is clearly the case for France, but even for Spain, for most maturities. So this is something like our policymakers should keep it in mind. And the second thing is that there are returns to the broad investor base. So we make the claim that the US Treasuries pay such a low interest rate due to the fact that everybody can hold them. And so there are returns to this idea that everybody can hold your asset, and issuers that want to emulate this property of US Treasury should sort of go down this road. The third takeaway is this non-linearity in QT. This idea that once a central bank has been doing QE for a long time and it says, okay, we're going to cut back purchases by 10 to 20%, the effect on spreads will be muted. However, when the central bank says, okay, now we're not going to do anything, then the effect will be much more pronounced. And this is what we've seen in spreads. And finally, I want to discuss briefly conclusions for the problems of common EU borrowing. So I have both a positive take and a negative take. Let me go first with the negative to end on a positive term. So the negative one is that increasing the size of potential investors to make the EU more like a sovereign is very hard. So the European Union, ever since me and my co-author published our findings, has been trying real hard to like be perceived more as a sovereign by investors, for example, by pushing for inclusion into broad fixed income indices. It hasn't managed to so far, but we might see changes in the future. But this remains extremely hard, and unless I mean, short of a revolution, it's hard to see investors perceiving the EU as a sovereign borrower. However, the positive thing is that there is no EU penalty. So some people have argued that like the European Union is perceived as unsafe, as untrustworthy. That's not true. Okay, so I've shown you that like the European Union pays just as much as German KfW. So there's no such thing as EU penalty, but it's really just market segmentation. And with this, I conclude, and I'm looking forward to the discussion.
Okay, thank you very much. Questions? Yes?
So you speak about the size of the potential investors, so who can purchase these bonds as determinants for the yields?
Yes.
What about the size of the issuance? So like Germany issues more than probably all these EU institutions combined and the FW.
Yes, great question. Let me just say, in terms of sizes, all these issues are comparable. The EU institutions, they sort of like, you should think of them as having pretty much 300-400 billions of outstanding each, which is the exact same amount the Netherlands has. Yeah, the Netherlands pays much less. So this is not the size. It's a great question, but Netherlands is actually Netherlands is smaller than what I call here as European Commission, and yet it pays much less.
Yes.
I'll discuss later on those. I think it's a fact that the European Commission, from the period that you see the increase in spreads, has been issuing, I don't know, hundreds of billions that were not there, right? And I'm assuming that that has a cost. You need to place that debt that is new from a new issuer in the market. So I would be expecting something like this. And then because all of these European guys, they rely on the same set of warranties, even if in different forms. And I think that's an issue that I don't know how much you can take of it. But the fact is that the warranty structure of each of those institutions is different, legally different, which implies that the place that Germany takes in paying for all is precisely different, and a potential source of different pricing. Years of liquidity.
So regarding your first point, the fact that the European Commission has been issuing a lot. So I would also, the deal that you're referring to happened in August, actually July 2020, so 2 years before this. And the EU had been issuing a lot during this period. So it didn't increase its issuance here at all. Okay, and if that was due to the fact that they increased more, then why did KfW react this in the exact same way?
Yeah, I knew that all the time. That's the way they are financing the next generation EU, right? It should have been talk about right? I mean, it's new that.
It is new that, but it was already expected here. Nothing happened here about to this debt. If anything, the take-up of these loans has been much lower than the EU predicted, and the EU has been issuing much less than the market expected. But yet, this didn't translate into lower yields. So the EU has now issued at least 300 billion less than what the market expected 2 years ago at this point. So I would argue that the type of spread should be the opposite.
Okay, any other questions? So I'll write on time, so thank you very much. Our third speaker is Naomi Cohen on food prices and debt stress.
Hi everyone, thanks a lot for having me today. This project is joined with another PhD student from Sciences Po, Rodrigues. Okay, so the project started from the observation that there is high volatility in food commodity prices. And so here you have like two graphs of historical data for prices. So on the left, it's like the global price of living index from the IMF. On the right, You have like prices of maize, rice, and soybeans and wheat. And basically what you can see is that they're very volatile. Here you can see that they seem to move quite a lot together. And especially that 2022 was associated with a big increase in the price of those food commodities. And so what we want to answer a question is what's the impact of rising food prices on the probability of default for low-income net importing countries? And so the mechanism that we have in mind is that when you're a net food importer, then food is difficult to substitute and it's an essential consumption. So it's not like you can just stop to consume food. And when there is an increase in the food import prices, it's going to decrease your foreign and your overall consumption, and therefore this will translate into a decrease in your utility. It's going to modify the trade-off between repaying debt and defaulting. Why? Because in this case, the cost of repaying debt will increase because it means you need to substitute more resources from consumption to repaying debt, while the relative cost of defaulting, which is high in the first place, is going to decrease. And therefore, because there will be this change in this trade-off, it means that it's going to increase your probability of default, which is going to translate to a decrease in the interest rates that you're going to pay on your debt, which translates into an increase, like it's going to be even more costly for you to repay back debt, and therefore this is going to trigger a multiplier effect. And so overall, this could trigger both a food and a debt crisis. And so what we're going to do in our paper is we're going to have both an empirical and a theoretical approach. So we're going to consider food as a specific term of trade shock, which is associated with a low elasticity of substitution. And we're going to focus on 4 major food-related commodities: rice, maize, wheat, and soybeans. And we're going to focus on Ghana. Why Ghana? Because it's a net importer of food commodities and because it's defaulted on its external debt in December 2022. And so we're going to have a dual approach. First, a theoretical model where we're going to have a sovereign default model augmented with trade to identify the transmission mechanism, and then an empirical strategy with an instrumental variable to identify external shocks on global food availability. And we're going to use local projection methods to estimate input response function on Ghana's aggregate variable and therefore validate those transmission mechanisms. And so overall, I hope that I'm gonna convince you that an increase in food input prices can trigger a country decision to default. And so just to highlight very quickly our contribution, so we speak to the literature on the impact of world price shocks, but compared to this literature, we particularly focus on food commodities, which we think are associated with a low elasticity of substitution. We also speak to the literature on sovereign default. So first, because up to our knowledge, we're the first to implement trade in the standard sovereign default framework, which gives a structure to this term of trade shock, which was really looked empirically over. And even on the empirical side, we shifted the focus on net importer, where was a net exporter, which was quite intensively looked in the literature so far. And finally, there is a whole literature which has focused on the effects on food availability following a country's default, but we think that the reverse is also interesting, and so we want to look at the impact of food prices on sovereign default, and we think it's particularly policy relevant. Okay, so on the theoretical part. So we're going to have a small open economy with an endowment YT, and there will be a continuum of risk-neutral international investors with access to risk-free interest rate R-star. And we're going to have a consumption basket, which will depend on certain parameters. So it will be a composition of what you consume from your domestic production, what you consume from foreign production. It's going to be dependent on this alpha, which will be your import share, and on this elasticity of substitution that we're going to calibrate to be low, such that the good will be imperfect substitute. We're going to divide the term of trade at the ratio of the foreign price to the domestic price. And then if you solve this consumption basket in the intra-temporal way, you're going to find the optimal allocation, which is going to be that it's going to depend how much you're going to consume of this stood good. It's going to depend on the import share and on the relative prices. And if you do a bit of math, basically you can re-express those two terms in color, only depending on the term of trade. And so in the end, the constraint that the small open economy will face will be, so you need to consume how much you're going to consume of your domestic production, how much you're going to consume on foreign production, the price that you pay on your debt, the amount of debt that you decide to issue, your endowment, and how much you need to pay that from the next period. And thus dividing everything by PHT, you can re-express everything depending on the term of trade. And so we're going to make some simplifying assumptions. So basically, first, we're going to normalize the price of the domestic good to be equal to 1, such that then the term of trade will only be equal to the price of the foreign good, and that inflation will be equal to 1, such that only the price of this foreign good will matter. We're going to assume a constant endowment at each period, and we're going to have an import price premium when defaulted, which will be calibrated in the same way that Arellano is doing for outputs in her paper. Such that when you decide to default, you're going to have a premium on the price that you pay on import. And so overall, at every period, the government is going to look at the value function when it comes to repaying debt or to default. It's going to choose optimally based on those two value functions. And you will see that it's going to depend basically on the consumption under these two scenarios. So here you will have like consumption if you decide to repay. So basically you repay the debt and you can issue a new amount of debt. While if you're deciding to default, you don't have access to international market anymore. So basically you can consume only your endowments. And then at every period, you have the probability to regain access to international markets, which is this theta. And so here you're regaining access to international markets. So you're starting with the zero debt. And here you're still excluding. And so you're going to see that this consumption will depend on this J function, which is going to be depending on your import share, your elasticity of substitution, and the price of the foreign good, which is basically a bit format here. And here, if you decide to if you're defaulting, you're going to pay this premium on import prices. This is why you have this like P at tilde here. And so, if we put that in the model, what's it going to look? It's like high input prices increase the cost of debt and incentive to default. And so here we're plotting like two lines. So the blue is in when prices are high, so 20% above average, in orange it's when prices are low, so 20% below average. And so here basically you should read this as like the debt as a percentage of GDP. And here it's going to be the interest rate. And so basically you can see that for a given interest rate, the amount of debt that you can issue when the prices are high is much lower than the debt that you issue when prices are low. So basically, having these high input prices increases the cost of debt for you. And here, when you look at the value function, so basically here, when it's coming a straight line, it means that you decided to default. You can see that first, there is a big difference between these two lines, and especially that when the prices are high, you're going to choose to optimally default in something which is around 75–80% of the GDP, while when the prices are low, you're going to choose to default for something which is closer to 150% of GDP. So it increases indeed the incentive to default. And then now if you plot the probability of default, so the region of default, which means like how big should be the shock for you to decide to optimally default for a given a given debt as a percent of GDP, we're showing you that higher input prices increase the per region under all debt value. And so basically, if you have a low amount of debt, a very high increase, a very high shock can make it optimal for you to default. While if you already have a high debt to GDP ratio, even a smaller amount, then a small shock can trigger you to default. Okay, so now on the empirical part. So the thing is that we want to validate this transmission mechanism empirically and not just theoretically, but terms of trade and business cycle and debt distress, they're all really related. So we need to find a strategy to identify a direct channel from a change in the price of food prices to debt distress, which is not related to business cycle. And so what we're going to do is that we're going to use an instrumental variable approach, and basically we're going to compute unexpected quarterly harvest supply shock from 1972 to 2022. And so how are we going to do it with this? We're first going to take all the FAO data on like the four commodities that I told you before. So rice, maize, wheat, and soybean for all countries. And we're going to construct a global food production index based on those four commodities. And then we're going to use the fact that crop production is seasonal. And so we're going to rely on the work of Dillon and Pearson, who has constructed crop calendars, but that we're going to be able to allocate this annual production to specific quarters based on the crop calendars. And then we will have this exogeneity, which is that there is a delay of at least 1 quarter from planting to harvesting, such that if something happens in the international market, for you as a farmer, it's not like you can directly react to it because there is this delay between planting and harvesting. And so then we're going to be able to compute the shock, which will be the difference between realized and anticipated production. Therefore, it should be something that happened like a crop disease, like a food that has made that what would have been optimal for you to product is in the end not what happened. And so then we're going to estimate the effect over 1 standard deviation decrease. So it's going to be a negative supply shock using monthly data from Ghana from 2008 to 2022 and Georgia local protection methods. And so we're going to estimate this for several variables. So first, we're going to look at the effect of the negative shock on inflation. And so we're going to, I do not have time to show you, but I have more if you have questions on this. We're going to see that once this supply shock, this negative supply shock triggers an increase in import commodity price index. It's going to trigger an increase in the inflation of food. It has no effect on the inflation of non-food, but in the end, it has an effect on the headline inflation, which shows, once again, how important food is in the basket of Ghanaian consumer. We're also looking at the effect on trade. We're going to demonstrate that it propagates to an increase in the exchange rate, which means a depreciation of your currency. It seems to have no effect on total export, but an effect on the overall import in USD that you have. And overall, it's going to trigger a decrease in your trade balance. And if I take a few minutes to talk about the financial condition, here what you can see is that it seems that if negative shock implies an increase in the spread that you're going to pay on the market. So this is month, and this is a response that you should translate into percent. And so you see that there is an increase in the spread up to 4 months after the shock. So it's becoming more costly for you to borrow. It seems to have no effect on domestic debt, but a long-term effect on the external debt. And basically, we explained the fact that there is a delay from this, that you roll over in your debt. And so here, the new debt that you're borrowing at a higher price translates into a long-term increase on your external debt. And in the end, it's translating into an increase in the total debt in dollars that you have. And so overall, on the empirical part that I done to try to validate, this transmission mechanism is going to show that we're showing that an increase in import prices translates into a decrease in terms of trade, which translates into a decrease in the trade balance, which also translates to an increase in the spread and an increase in the external debt, while no effect on the domestic debt, which overall means that you have more incentive to default. And so we do some robustness check in the paper. We check that this is also valid with quarterly data, and especially if you have the 2022 story in mind, you could tell me, okay, but all the things happened in 2022. There was a monetary policy shock in the US. There were also a negative oil shock, and basically we do counterfactual with these two variables, and we can show you that it doesn't seem to be it doesn't seem to have a very high effect on Ghana's external debt. These two elements in 2022. And so overall, COVID-19 crisis, the conflict in Ukraine, and surging global commodity food prices, it has driven an increase in import prices, which has translated into a decrease in terms of trade, which had a big impact on the world's poorest country and net importer. And overall, we think that this is partly what explained the increase in the number of sovereign defaults that happened over the last few years. And so what we do in this paper, we identify transmission mechanism theoretically and demonstrate that an increase in prices can lead to default for import-dependent countries, even with low debt. And then we validate this transmission mechanism empirically from an increase in import prices to debt repayment. And so overall, it provides potential explanation for Ghana's external debt default on December 2022. Thank you.
Thank you very much. Then we have some minutes for questions and comments.
Thank you very much. I love DebtCon because it brings together scholars from all different kinds of fields. And so I was wondering, so you say that, hey, if there's food price shock in a sense, the country will default. Or there's a higher likelihood, right?
Yes.
The decision to default or not is not an automatic decision, right? There are politicians that make an active choice to do this or that. And politicians differ, right? There's differences in regime types, there's differences in kind of the constituencies, urban bias, rural bias. I'm asking this with the background because in 2016, Camarada Rosa published an article that suggested the very same mechanism in a sense. It said that it only applies in autocracies and only applies in countries that have an urban bias where there's a large population that kind of relies on food imports, whereas in other countries, that's not the case. Can you tell us anything about the potential of that mechanism that you identified?
Yes, that's great that you're asking this question because it's actually our research agenda. So now we want to extend what we did to other countries, not just Ghana, and especially look at like how is it dependent on this import share that you have? How is it dependent on your consumption basket? How is it dependent on the elasticity of substitution regarding what you're producing in your own economy? And so actually, we want to like be able to make a clearer point by extending to more countries with different like background to be sure that this is really, I mean, to convince you even more that this is a mechanism and to highlight when it is actually happening. Yeah.
Yes. Very nice presentation. I find this a super convincing story, as you know. But one thing that I wasn't so aware of, and that sort of put me off a little bit. I'm wondering if you have some empirical evidence for it. To make it elegant, make it fit with the Arellano framework, you make this assumption that food prices change if the country defaults.
Yeah.
They increase. Do you have any empirical evidence for that? Or is that just because otherwise it would get very unelegant?
That's a good question. I'm not sure if I have. No. So what I can show you is that for the inflation, it was the case, and this also translates to inflation for food. So you see that in 2022 there was a very big increase in inflation regarding like headline food and non-food items for Ghana. So I could give it a closer look, but basically it seems also intuitive in the sense like this. If you have in mind that there, and especially regarding the empirical finding that we have for the trade that is going to depreciate your currency, then in any case it's going to translate into an increase in the terms of trade for you because your currency depreciates. So that's why also we think the story of the import price premium is convincing.
Yes.
Yeah, so really great presentation. Just a comment. That shows that exchange rate depreciation doesn't affect exports, but it affects
import.
Yeah, but economics says that exchange rate depreciation should make your exports cheaper.
Yes.
Right? So,
but it depends what you export then, right? So especially if you have this low elasticity, like the jigger that you have in mind with the special condition, it's really relying on the elasticity of substitution that you have. And especially if the elasticity of substitution overall is above 1 or below 1, and like if it's a big elasticity of substitution, if they're a perfect substitute. Here, that's what we found. Like we think this is kind of convincing mechanism because actually you cannot really, even if the currency depreciates, it doesn't necessarily translate to an increase in the total export because you have like this price and quantity effect. And so especially depending on what you're exporting and like how the price will move on the market, it does not translate directly to an increase in exports. And so here it's going to translate to an increase in imports because actually it's going to make imports more expensive for you, and you have a low elasticity of substitution on these imports. And so it has to be that even if the price increases and not decrease quantity of what you're importing too much, this is what there is an increase in the imports in dollars that you pay.
Okay, I think we stop here. Thank you very much. Now we move to the fourth paper. The presentation will be by Caterina Seghini, and the title of the paper is Sovereign Debt Liability, the Carbon Budget and Climate Changes.
Thanks for being here. So for the first session. So this is one of my two papers on this topic on the consequences of climate change on sovereign debt sustainability. And it benefit from discussion I was involved in during my period as visiting researcher at the Banque de France. Two challenges. So the first one is what are the consequences of climate damages on public debt sustainability, and the second one is what are the consequences of transition costs from public debt sustainability. So as we know, globally we have an increase in public indebtedness over the last decades, both in developing and advanced countries. I especially concentrate on advanced economies. In my studies. In the policy discussion, we know that these issues are important, are relevant. We are discussing a revision of European budgetary rules in order to improve the transition costs into consideration. And for example, they are discussing an exception to the 3% deficit rule. If the amount that we need, the amount that we need to overcome the deficit, 3% deficit is related to transition investment. In policy discussions, the issue is present. In the academic literature, it's still the evidence is still scarce, especially from the modeling point of view. And in this paper, I especially concentrate on the consequences of climate-related issues on fiscal limits. And I include in traditional measures of fiscal limits, first the economic cost of reducing emissions, then climate damages, and I also, in a stylized way, take into account the issue of political coordination in the transition that determines if we are successful or not in keeping temperature under control. And it is this paper wants to position itself at the intersection of two literature. The first one is the macro-financial research on fiscal limits and sustainability, and the second one is the macro the research on which incorporates into macroeconomic model climate considerations and transition considerations. So the literature, as I said, is quite scarce. So let me mention one important contribution from the modeling point of view. It just arrived.
For everybody.
Okay, so so I'm happy that so we know, thanks to his work and other works, that the link is there. There is there that climate change has a fundamental impact on the sustainability issues, and it does that incorporating output from integrated assessment modeling to the sustainability analysis. This is a different work. A different way of tackling the issue. As we also know, sustainability is determined by the situation where the debt to GDP is lower than the fiscal limit. So we don't have a sustainability problem if this condition realized. The climate-related issues affect both sides of the inequality. I concentrate here only on the consequences of fiscal limits. I remain agnostic on what happens to the debt to GDP. I only want to look at what happens to the maximum debt to GDP that is sustainable for a given country. So that the government does not have issues repaying. I concentrate on vast economy, and therefore in order to determine fiscal limits, I assume an involuntary default framework. Usually for developing economy, we use a strategic default framework. Traditionally in the literature that assumes, that takes this position, fiscal limits are determined by the distribution of the growth rate of the economy, the risk-free interest rates, and future potential primary surplus. I concentrate on the impact of climate-related issues on the growth rate. How much time?
No, 10 minutes.
Okay, so briefly, the main results. So I follow the climate, the climate-related literature, and I simulate my model for different scenarios regarding the global emissions and the national emissions. So the first one is a transition scenario, and my evidence is that in the short term, fiscal limits decrease due to abatement cost. And this might create sustainability issues for some countries, for example, Italy and France, depending on the magnitude of this abatement cost. If the transition is successful, so if we are able to keep global emissions and temperature under control, we have that in the long term fiscal limits stabilize so go back to higher and stable levels. If we are not successful in performing the transition, either because we don't do anything about it, so we follow a business as usual scenario, or we fail in coordinating the transition, we have that fiscal limits decrease over time for all our economies. So let me show you the model. So I extend the model by Collab and Rocher of 2015. So in their model, they defined the fiscal limit as the DT, which maximizes the government's borrowing B of DT. B of DT is simply, so basically this is the borrowing to GDP. It is the, if you want, the market value of debt, DT is the face value. And it is simply the, of course, the ratio between DT and the interest rate of government debt. We assume, I follow their assumption of risk neutral investors, so that the RDT is just given by the simply given by the ratio between the risk-free rate and 1 minus the probability of default. This probability of default is defined by this condition. So we have default if the growth rate is lower than this threshold. This threshold, which is given by the amount that we have to repay and the resources that we have to repay debt. So alpha is maximum, the maximum primary surplus. So this represents the maximum amount basically that the government can extract from its economy, and is used to represent the future potential primary surpluses and the future BNT, so the future maximum borrowing to GDP that is considered sustainable. This is basically a standard model of fiscal limits. What we can say from the evidence in the macro climate literature that the growth rate is affected by climate-related issues. So, I divide the growth rate into what would be the growth rate of a green economy and what would be the contribution of emissions. Given that I want to remain general in terms of the policy choices that we take in order to perform the transition, so we have different alternative carbon taxes, invest direct public abatement efforts, subsidies. These have quite different macroeconomic consequences. So my choice has been to remain agnostic in this regard, and just look at the empirical literature and take a sort of average of those costs. Follow the results of this OECD researcher, where in this paper they constructed the environmental adjusted multi-factor productivity, and they also estimate a short-term abatement cost. This represents the elasticity of output to emissions. I also do some sensitivity analysis around this data. So basically, this represents the contribution of emissions to output. And they also define a green growth rate, net of abatement cost and solution. Okay, so just a few observation on this definition of the fiscal limit. This is a forward-looking measure. So you can see that the BNT, so the maximum borrowing to GDP today, depends from the entire path of emissions. We iterate forward this equation. We obtain this measure that makes clear that so that sustainability today is determined by the entire path of emissions. So what I use in order to basically simulate my model is so I take from the OECD paper this first parameter, so dirty growth distribution, being the growth distribution, the short-term abatement cost. Then I take from the financial point of view, debt to GDP. I position myself at the beginning of this 5-year cycle for the Paris Agreement. As you know, every 5 years, we need to, the states need to update their national determined contributions. So I calibrate my model on 5-year periods, which both corresponds to the average maturity of government debt and this 5-year cycle. So I position myself at the beginning of this current cycle. And I take this is alpha, the maximum primary surplus, taken from IMF data, and two other things from the climate point of view. The NDC that I basically looked at NDC of every country, and I extrapolated the cumulative emissions of for the current per cycle, and taking IPCC evidence, the remaining carbon budget of all economies, like of all countries analyzed. I analyzed 33 countries. Here I show evidence. I'll show evidence only for France and Italy. And I take a 2 degrees scenarios. 2 degree scenario of with 67% probability. And I also this national carbon budget is determined using a let's say a fair per capita criteria. There are different criteria in order to do that. I follow some of the literature which make this assumption. Okay, so let me show you my results. So when so first of all, this is a transition scenario, and I do not take into account climate damages. I will introduce later climate damages. So when I maximize, if you want, current debt sustainability, so the current borrowing debt to GDP under my carbon budget, so the cumulative emission from today until the future, until forever, has to be lower than the carbon budget of the given country. Here I show my results for different expansion of the long-term growth rates. So the long-term green growth rate after we have performed the transitions. So there has been some evidence in the empirical literature on the macroeconomic cost of the transition that's basically is able, if you want not to rely on this parallel hypothesis, it would be my benchmark assumption for the next next graphs. So one observation is that, of course, the growth rate that we will be able to achieve after we have performed the transition is quite relevant for future fiscal limits and for today's fiscal limits. So as you can see, if for France, if this is the fiscal limit, this would be the emissions that the emission path which maximize today the sustainability, the today fiscal limit. And we would have that for France, if the red scenario is around 130%. When we go to Italy, we see that this pessimistic scenario is able to put the Italy close to its current debt to GDP. So it should be of 2020. There was COVID, but I kept this assumption because of also the high. I think that's we can safely keep this assumption also because in the future very likely we increase the transition cost and the climate and the cost related to climate damages will have a positive impact, adverse impact on debt to GDP. Okay, so when we increase the beta, the short, so before was for the long term growth rate. So this is for the short term abatement cost, so the beta in my model. And we see that, this was from the OECD results. This is, so I would say that we could put these are very adverse scenarios. So if you want a disruptive transition, I would say that we can, the short-term abatement cost is around this area. So we can see that also for France, potentially could create sustainability issues, and even worse for Italy. If you want to, we can, I the paper also have a, let's say, welfare maximization analysis when I maximize the present value of GDP. If we want, we can talk about that in the Q&A. And the most important results, if I have one more minute, when we include the climate damages, so what do we have? If we are able to coordinate the transition globally and keep global emissions and temperature under control, we are in the green scenario. So we are able to basically stabilize the fiscal limits in the long term. If we fail into doing that, either because we follow a business as usual scenario, so the black line, so basically France and all of the rest of the world do not do anything, we have the fiscal limits basically decrease, for example, for France to 90% by basically the end of next century. The orange scenario would be the scenario where France does the transition, but the rest of the world does not follow his advice. So basically, the policy implication of that would be that not only Europe is the one probably more advanced in performing green efforts, but even if it is successful in doing so, in respecting an hypothetical carbon budget for the European economy, this would not be enough in order to prevent any financial issues for European countries in the long term if it's not able to guarantee that all the rest of the world follow its advice. So thank you. There's a summary of my results, and I'm happy to listen to your questions.
Thank you very much. Question or comments?
Hi, Ben.
Okay.
But first, I want to apologize for the other students for showing up late, but Uber was cancelled. So, I mean, I know you're very, very careful, as you know, and I like very much, but I'm puzzled why you focus on growth. For two reasons. One, there is literature that the effect of different growth is very small. With some papers say it's significant. Some say it's very small. So why look at that aspect of the problem? Well, the second thing is, which I think you can deal with, this paper you are referring to is using historical data. But then you're looking at the country contribution. So that's nice you do forward. So could you calibrate forward-looking projection?
Yes. Thanks for your question and for reading the paper. So first, why do I focus on growth? Because as you know, the sustainability in general is we don't have other sustainability issues if the growth rate is higher than the interest rate. Then discussion if it's like risk interest rate. I would think that from the result from this model, it would be that we don't have to compare the G on to R, but R and something. And we don't have the sustainability issue if G is higher than that, right? Yes.
Is it a real problem, transition? Is it a problem of growth? The DSA?
I think also, I think that there's more and more actually, like the recent literature has evidence that actually transition costs are bigger than expected. So I believe that we would be able to find an effect also on the growth rate. And for example, I know that the paper by Metcalfe-Stock, that is the one that, for example, do not find any evidence on the growth rate. This is focused only on carbon tax, only as on a small carbon tax. So I think that this is a successful transition scenario. So the abatement effort that we will do is way bigger than what they analyzed. So, and I think that if we did what we really need to do, of course, we would find higher effect on growth. And I take some empirical data in order to estimate this beta, the short-term abatement cost. So the fact that reducing emissions had an impact on growth is there, actually, on economic output, and also growth is there, and they have it in their results. So I think that some evidence there is more and more that there is also an impact on growth. Why do I focus only on growth? Also, there are other determinants. So volatility, because I only focus, if you want, on the average at some point. Volatility, the risk-free interest rate, the alpha, the maximum primary surplus. But I think that the evidence there is still quite scarce, especially risk-free interest rate would be driven by the global dynamics. The maximum primary surplus is a potential value, so it's very difficult to say that would be affected. And the volatility, the evidence is still quite scarce, and I think that depends a lot also on the macroeconomy. Of course, it's interesting to analyze that. Then your second question was, yes, for forward, yes. Potentially, this model could be used to take IPCC scenarios and see what happens to the debt limits. Actually, I'm discussing with people at Banque de France to take the NGFS scenarios and see what happens in terms of fiscal limits. So.
Okay, fine. Thank you very much for that. Okay, now we have our last presentation by Nicola Benigni, the value of government debt with domestic arrears.
So welcome everyone. I'm Nicola Benigni and talk to you today about valuation of government debt with domestic arrears. So first of all, what are domestic arrears? Those are overdue payments that the government owes to its beneficiaries. Those could be suppliers of goods and services to the government's contractors, or even government's employee. So a typical example would be a construction company that carry out some maintenance work on a highway, then invoices the government or the local administration for payments, and the local administration says, I'm going to delay these payments to a time where I'm going to have the sufficient liquidity to pay them. And it's important to highlight that this form of claim on government resources is separate and different from a claim that bondholders, so holders of marketable debt, may have on the government resources. Indeed, you see, these domestic arrears are nothing else than a unilateral loan that the government forces upon its suppliers. I'm going to make the point in the paper that it's important to consider domestic arrears when measuring government primary surpluses. That domestic arrears are employed strategically by the government to warrant higher debt valuations and reduced probabilities of default. And as an explored channel of financial repression, domestic arrears may indeed help the government navigate periods of say, liquidity crisis or rollover crisis. This has implication for the debt valuations overall, as implication for the trade-off between insuring bondholders and taxpayers, as implication for the riskiness of marketable debts and the probability of default, and on fiscal capacity. So I'm going to speak to some of these points.
Now, I have a slides with a few equations already, but I think it's going to be helpful to highlight the contribution here. So here we have like a standard valuation, debt valuation equation with the value of marketable debt on the left-hand side and future discounted primary surpluses on the right-hand side. So those are the differences between tax revenues and government spending, discounted by a stochastic discount factor. And so as the holder of all outstanding bonds can expect these primary surplus as cash flow from the investments. And what highlight, so the point here is that this literature has always taken the cash flows as difference between tax revenues and government spending without considering the role of that arrears play, because arrears are a separate form of debt due or owed to a different group of investors than the bondholders. Then anytime arrears are accrued, that actually increases the amount that goes to bondholders by reducing, let's say, for given taxes, arrears reduce the government spending. And these may lead to higher valuation. Like we've written here the same valuation equation, just developing the expectation of a product as the product of expectations plus the covariance term. So we expect, and just focusing on the role with these covariance terms play, we expect a negative covariance between stochastic discount factor and tax revenue. So in period of economic distress, when the stochastic discount factor is large, tax revenues usually decline. We expect a positive covariance with the stochastic discount factor, and government spending. When in period of economic distress, government spending usually also rises. And I'm going to show you that arrears are indeed accrued in period of high economic distress, and so they contribute positively to the value of marketable debt. And as a channel of financial repression, arrears may also increase fiscal capacity overall relative to a counterfactual world in which government does not use them. So the intuition for that is that you can expect so forward-looking and rational suppliers to anticipate the government using arrears, and so the amount that they may charge the government for their services includes the cost of the services plus a surcharge that should perfectly undo the effect of arrears. But as long as the government has some pricing power against this supplier, and this may be the case if there is a monopolistic relationship between the government and some of the suppliers, may it be military contractors or construction companies, then we have higher debt valuation compared to a world in which the arrears are not used. In the paper, I focus on the historical UK prior to World War I, which made ample use of domestic arrears with average 5% of GDP. I model and estimate the present values of taxes, spending, and arrears using Campbell-Schiller decomposition of price dividend ratios of these fictitious securities that pay a cash flow of tax revenues or spending or arrears. And I find that arrears have a present value that is 18% of GDP on average. That means that with arrears, the the debt value is 80% percentage points higher. And in terms of comparison, that is, you can think of it is as important as the seigniorage revenue that the government generates from a 1% convenience yield on marketable debt outstanding. I have here a picture of the stock of arrears in the UK over this historical period. So they average, they were saying 5%, but we see them spike in these gray shaded areas, which are periods in which the UK was historically at war. So they always spike when the UK goes at war, and they're instead repaid in the peacetime in between. And here is a graph of the flow of these domestic arrears in orange, plotted against the flow of primary surpluses. And what we should take away from this picture is that they are indeed employed strategically. So they are accrued exactly in periods of large deficits. So when, say, as a bond holders, you may get scared by the large deficits and the ability of the government to repay you, the government accrues those arrears. So ensuring, if you want, the repayment of debt holders at the expense of other suppliers. So that's going to be the story. Contemporaneous data on arrears is hard to come by, but I have some sporadic evidence that these are still a channel that matters today. So in France, the stock of outstanding arrears was 1.6% just last year. And you can imagine that in low and lower middle income countries, this number is larger. And in particular, the more authoritarian the regime, we can think of the larger the market power of the government against its own supplier, the more the country can actually, through this channel, can support the valuation of marketable debt. Think about, for instance, of Russia, which is an authoritarian regime and didn't want at all costs default on external debt, even following the sanctions. I sketch here how I think of modeling these present values before coming to the conclusion. So we are after these the same valuation equations, and we are after these present values of taxes, government spending, arrear creation, and arrear redemptions. We need the price dividend ratios for each one of these assets, if you want, such that by inverting them, we can recover the price, which is of course not observed. The price dividend ratios are log linearized and estimated with a vector of a regressive model. So I come now to the results. Here in gray, you see the value of marketable debt to GDP in the UK over this time period, and in light blue, the present value of future surpluses, which lies below the market value. This arises this valuation puzzle. How can so the market value lies above the fundamental value? With considering arrears in the computation of these primary surpluses, I can close this valuation gap. And I plot here in orange the present value of arrears behaves over time, averaging 18%. So over the time period, the average value of marketable debt was 99% of GDP, and the valuation equation yields 75% without arrears, but 93% with arrears. So including arrears in the primary surpluses is quite important to get this valuation equation right. In conclusion, domestic arrears are a separate form of debt than marketable debt. They are necessary to measure government cash flows to bondholders correctly. they warrant higher marketable debt valuations, and as a channel of financial repression, they may raise fiscal capacity. Thank you.
Any questions? Yes.
The first question about your data, I think it's a very important topic. Correctly, you said it's not only of history. I mean, I've seen also in Cyprus, where it's the crisis, in Greece.
Yeah.
But you need to have data, more recent data for the work to be meaningful. And also to be able to separate arrears that have to be paid. Like if the government is late in paying suppliers, it's one issue, they have to pay them. But some things the government may not do, like when the US government shuts down and lets employees take unpaid leave for 3 days, they don't have to pay them. And the second, more fundamental for your model, the pricing depends on the discount rate that applies as the country goes through the cycle. Right? So there is a risk premium that's changing. How do you capture that?
Quickly to these two questions. Sorry on the last one. I take into account the risk premium that the risk averse investor may pretend for holding these type of securities, and that's exactly what you see through those the covariances term. So that's taking into account. And in terms of longer data, and so that's I mean useful to someone else as well. Eurostat actually, I found out so some modern data. Eurostat collects these outstanding arrears. They are buried into like the last page on an extra table that they require from the countries, exactly to reconcile surpluses with measure change in outstanding debt. So I think the coming month I'll look at those data and then show you the results.
Okay, maybe the next question. Well,
Okay, so it's related to the data question as well. But one thing that I know that in the emerging world that happens is that sometimes arrears are covered by the government essentially extending credit through state-owned financial networks. And that effectively covers the gap of the arrears. But then later on, you have a separate sovereign bank nexus problem. I don't think that's something you specifically looked at, but any kind of ideas that you would say how your conclusions would change or not, depending on incorporating that kind of idea?
Yeah. So if well, okay, we've seen it before that apparently so borrowing through government-owned enterprises is more expensive than issuing bonds. But if it's true that if the government would raise resources, a lot of resources through, say, a bond issued by government-owned enterprises, that channel should also then matter for the primary surpluses, and it should be accounted in the equation as well. Yeah.
okay, no other burning question. I think that we have to stop here, and we have first to thank our emerging scholar.